When investing in stocks, investors need to understand the distinction between intrinsic value, which is represented by this orange line on fast graphs, and market value, which is based on sentiment. The orange line is based on discounting fundamentals like earnings and cash flows back to the present value. Sentiment is the market value, and stocks can trade outside of their intrinsic value for periods of time. But as you see, when you correlate the price with both the intrinsic value and the market value, you see that stocks always come back to their intrinsic value and even sometimes get below it. But they also can trade at valuations that are outside of the intrinsic value for periods of time. This is BlackRock, the largest investment manager in the world. They have over $10 trillion in assets. And as you can see, this company was significantly overvalued just this last couple of years, and now it's reverting to its intrinsic value, if you will, or coming down into fair value. Hello, everybody. This is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool. I want to welcome you to another one of my videos where the theme of my last video that I produced on Wednesday and the theme of this video is really looking at how the market is beginning to correct after being overvalued for a very, very long period of time. And what we're seeing is, especially in the dividend growth stocks, I did the dividend aristocrats, which was, companies that have raised their dividend for 25 consecutive years or greater. In this video, I'm going to look at dividend contenders, and I went through some 365 dividend contenders, and I came up with 65 of these contenders that were correcting. The problem is these companies have been overvalued for a very long period of time. Markets can be irrational for long periods of time. Investors need to accept that and recognize that. But these are the 65 correcting contenders, I call them. These are companies that have been significantly overvalued for long periods of time and are now beginning to come back towards their intrinsic value. But the correction process has just started. So I came up with 65 names here. But unfortunately, to do a video and cover all 65 of these names would be really too onerous to be able to get done. So what I did was I took and I called that list down even to a smaller list of 20 names that I consider to be very high profile dividend contenders. You'll recognize most every name on this list, and wanted to show you how much valuation has affected their most recent price action. And it's really affected it quite a bit, as you'll see, some more than others. Some have even corrected all the way back to intrinsic value. Others still have a ways to go, and I want to make sure that you see that, clearly. But I also wanted to go through and point out that, I look for a minimum earnings yield of 6.5% to 7% to indicate fair value on most companies. As you can see, I only have a couple out of this list of 20 that actually are, back to their intrinsic value. But I'm going to go over these in alphabetical order for you. And what I want you to get out of this is I want you to focus on the market value line, which is the blue line, to see how the market can irrationally price stocks for times. Then I want you to see the orange line on the graphs, which is the intrinsic value, which is what the companies are actually worth based on their cash flows and where the company normally will trade at. Like, for example, here's Agilent. I also want to focus on the fact that bear markets, this is the bear market of 08 and 09, I've gone past the 2001, but it was even shorter, but that led to about 6 or 7 years of a bull market. And more recently, we've had this long-running bull market since the Great Recession, was temporarily interrupted by the COVID flash crash, which some people consider a bear market, others don't. But these stocks got dramatically overvalued. And what I'm trying to get people to recognize here is to be careful of being geniuses in a bull market. Bull markets can mislead you because they can let stocks be highly valued, and that can happen for a long period of time. But at some point, as you can see on these graphs as I go through them with you, stocks eventually come back to their intrinsic value. Now you can see how irrationally exuberant or how optimistic or how greedy investors got if you look at Agilent. But now you can see since September of last year of 2021, the stock has begun moving back towards its intrinsic value and even back to its normal market value, which, there's the blue line. You can see that, that blue line is really a high valuation. So I want you to understand the white line on these graphs are also the dividends. These are dividend growth stocks, companies that have increased their dividend for 10 to 25 years. That's what a dividend contender is. So that's what I'm showing you here. And some have, longer streaks and shorter streaks. The next one I want to show you here is Accenture. You can see that Accenture had a long history of trading, somewhere between these two lines, the intrinsic value line. But then during this really extraordinary bull market we've been in, it got excessively overvalued. But now you can start to see the risk of overvaluation as this stock has begun to correct. That's number 2 in my list here. Analog devices is another one that typically has traded at a premium valuation oftentimes, but it also gets back to its intrinsic value quite often, and it's already dropped below its more sentimental value, or the blue line, and it's moving to the orange line. That's analog devices. AES Corporation, you can see it's a little more cyclical than the others I've shown you here, but you can see the effects of high valuation and how it can really impact stock prices. You can see how the stock price tends to track the earnings in the longer run, even though it gets disconnected in the shorter run. The stock got significantly overvalued. The correcting process has begun. These are correcting stocks. This is BlackRock, the one I featured in the beginning, the world's largest, again, money manager, over $10 trillion in assets. I want you to note how the market, gets excited about this stock quite often, and that gets it up to a 21 multiple quite often. But frankly, if you just look at this graph and recognize that it inevitably moves back into alignment with that orange line, and even when it falls below the orange line, it tends to move back into alignment. And then we have these bouts of overvaluation that ultimately lead to a big drop in price, and we've had this recent overvaluation that have now come back into alignment with fair value. The company has a really great dividend record. It's now getting real close to being attractive. It still has at least a little bit to go. I would like to see this stock down here to $630 a share or so, and it's at $730 currently, just to be clear. First Republic Bank of San Francisco, you can see how it, tracked its earnings. It got really significantly overvalued, starting to correct. The Fed, as we all know, raised interest rates yesterday, and interest rates, and dividend growth stocks especially tend to have a different relationship. When interest rates go up, the valuations of dividend growth stocks tend to go down. And when interest rates are going down like they have been for the last couple of decades, the valuation of these stocks tend to go up. But again, that's sentiment. That's not intrinsic value. I believe as a value investor, you should always be making your decisions based on trying to get intrinsic value. That's where, your prudence, margin of safety can come into view, especially when you can buy these stocks below that. Here's Honeywell International. You can see how it's always traded, within that orange line and blue line, the intrinsic value as well as even a premium market value it gets from time to time. But you can see how it always corrects back to at or below the orange line. It got pretty overvalued here recently. It's beginning the correction process. The next one I want to show is Intuit. This one really traded, intelligently, I'll call it, or in line with intrinsic value for many, many years. The bull market, everyone became geniuses. It got, exceptionally overvalued. Now we've had a very significant correction here just since the beginning of this year, and it's as it moves back towards fair value, and has a long ways to fall yet. I want to make that clear. ITT Inc., an industrial machinery company, you can see how it has, continued to gyrate around that orange line and occasionally trade at the blue line. But then, recently it got significantly overvalued, moving back to the intrinsic value. I call these, correcting contenders. And these are high-profile connecting contenders. I'm showing you just the ones that you would probably recognize the most. Here's Quaker Houghton. You can see that it has traded, in line with its fair value. How overvaluation has created a lot of volatility. It got significantly overvalued in 2021, and the price is beginning to come back now into alignment. At least it looks like it, as far as it's already dropped. The next one is Lennox International. Lennox International is building products. You might know them for that. You can see how closely it's correlated to its earnings growth. You can see the market value and the fair value have, related to that 19 or 20 times earnings growth rate that the company has achieved. And it got really overvalued. It's now moved back into its intrinsic value, and you can see that it's still got good growth expectations going forward. So it could be one of the few on this list that's already basically achieved, buyable status. Moody's, we all know Moody's and Standard & Poor's. Moody's typically trades at a premium, but oftentimes coming out of the recession of '08, which was financial oriented, this is financial exchanges. The company did get, in alignment with its intrinsic value. It got significantly overvalued here in the last couple of years, but we're seeing a significant correction now in Moody's. Market Access, which is the data provider and artificial intelligence bond provider, you can see how pricey it traded in reasonable valuations like it should. During this really radical bull market we've had, it got very pricey. Now it's beginning to correct prices. These stocks are starting to show their vulnerability. The great Microsoft, I almost didn't show it because it really hasn't corrected that much yet. It's a terrific company. If you shorten the time frame, growth has actually accelerated, which is remarkable for a $2 trillion company. But I still believe this stock, as high quality as it is, and of course it's one of the highest quality stocks on the planet, is not really investable at these levels because I think the risk is too high based on the price you have to pay to buy it. Remember, as Buffett said, price is what you pay, value is what you get. NASDAQ, this is the NASDAQ Stock Exchange. You can see, how it has traded consistently with its earnings justified valuation. It got significantly overpriced. Now we've had the correction process. Overvaluation can be very dangerous for even the best of companies, make that clear. Oracle, one of the premier technology stocks, recently got really overvalued. It's now coming back into reality. This is one I've been long on for many, many years, by the way, and it's now almost getting viable, but not quite yet. Rockwell Automation is another one that trades, in line with its intrinsic value. It got significantly overpriced. We've now seen a correction process starting. This is Starbucks. I've been asked to cover this one. Starbucks is really an enigma in a way. Has really good growth, over 17%. Of course, it was impacted by COVID, where they had to close their doors and they couldn't do business. But if you just kind of correct those two lines, together, you can see that it basically continues on the same trend it's historically gotten, although the growth rate has slowed down a little bit to about 12 or 13% from closer to 15 to 20%. But you can see even during this high valuation period here, which lasted for several years, you ended up with almost a 75 or 80% correction, the 74.4% on the dot periods that I covered there, and over the next 2 or 3 years. But then it rallied again and stayed very premium priced. It has now fallen below its historical premium valuation and moving into what looks like it could be moving into alignment with its fair value. If it did, then I would consider Starbucks very, very buyable. Scott Miracle-Gro is one of the few that has come back into intrinsic value. You can see how the stock has really traded at a price that made economic sense based on discounting cash flows back to the present value. You can see the effects of massive overvaluation and what they've had. I mean, just so you're clear on this, this correction here has already been, the stock has already been cut in half. And yet business wasn't that bad. They do have a down year expected for this year, and the stock was very vulnerable to bad news. This really illustrates how a stock that's really highly valued can be very, very vulnerable if there's any hint of bad news coming up. Anyway, this has been Chuck Carnevale, giving you another example of real high quality dividend growth stocks that are beginning to, trade at rational values. They haven't got there yet in most cases, but some of them have, as I've shown you. I just want you to make sure you have a perspective of how dangerous overvaluation can be. That's why, they call me Mr. Valuation. You can overpay for even the best companies in the world and not end up not making any money. And you can go down the quality chain a little, but stick with quality. I believe in always sticking with, investment grade, high quality stocks. But be patient. If you're patient enough, you can usually catch even the best of breed stocks, where most of these really are, at rational valuations where you can participate in the growth of the business going forward. Anyway, this has been Chuck Carnevale saying thanks for watching. If you enjoyed this video, give me a like, ring the bell so you can be notified of future videos. Subscribe to the channel if you haven't already. This is my ongoing series of dividend growth stocks, which have been probably the highest, or the most premium valued stocks because of the low interest rate environment. We started to get yields on these stocks that made more sense than fixed income. But as these valuations got high, the yields on these things, I want to make that clear, the yields on these things came down. And so they weren't so attractive anymore. And that's another thing that actually started the correction process. Anyway, thanks for watching. Talk to you guys again real soon.